Hi there, everyone. Welcome to another Ainslie's Gold and Silver Standard Insights. I'm Joe, and as always, we are joined by Mr. Chris Tipper, and joining Chris today is Josh Lang. Hello, gentlemen.
Hey, Joe.
All right, as we do here on GSS Insights, we break down the morning's news, and that's posted on ainsleyBullion.com.au. I will share the screen right now and also post a link below for everyone who's watching this later on. And this was an interesting one. This is entitled, China Cuts Rates as Economy Falters, Beware Australia. So who would like to go first?
I'll start off. So thanks, Joe.
No worries.
Yes, the news out of China today came as quite a surprise to a lot of analysts out there. But it really makes sense when you consider the background we've been talking about here on Insights over the last week and a bit. And when you look a little closer at the data behind the news, as was highlighted in that article that you've brought up there from Ainslie this morning. So basically what's happening is China's slowing very quickly. And yesterday, this found them needing to lower their benchmark interest rate when other central banks around the world, as you would know, have been continuing to say that they're going to continue tightening. I'm certainly wondering if this could be the first of many countries that end up pivoting much sooner than everyone was originally expecting, which is an argument I've been making a few times, as fear of a deep recession might quickly overcome any concerns that are out there about inflation. So I can really see a scenario where pushing rates much higher, whether that's in the US or here, actually leads to consequences spiraling out of control and the need for a quick pause or even a reversal if it becomes clear that a recession is already here. And that's exactly what we've seen today from China. What happens in China is particularly relevant to us in Australia, of course, and the article points that out. The Chinese are the biggest importers of production from our ore and coal exports. So hearing numbers like, I think it was quoted there, crude steel output fell by 6.4% year on year. And more broadly, the import of steel products were at their lowest level in 24 years. All of that's not great news for a massive driver of our country's prosperity and economic growth. So, it does have a direct and tangible impact upon us here. I should highlight, though, that it was only a 0.1% interest rate rise yesterday, which in itself is not much, but it's more significant in signalling that it gives to the market. So when all the other economies around the world are rapidly rising or raising interest rates, and China's lowering them, that's some pretty strong signalling that's going out. The main thing driving this decision was a raft of disappointing economic updates over the past week that showed Chinese growth was struggling on multiple fronts. So as we've seen in the recent past, when they are in this situation, when China is faced with a slowdown, Chinese policymakers quickly turn to tried and true tools that they use to attempt to kick growth back into action. So in the past, this has included pouring money into public infrastructure investment, encouraging a borrowing boom so that they can fuel more of that domestic spending, and delivering sharp interest rate cuts. So no one would argue that 0.1% is a sharp interest rate cut. And the public infrastructure investment has largely been on pause with the rolling COVID lockdowns. And of course, China's had that zero COVID policy, which has seen a significant slowdown across the country in their ability to build anything new. And that makes perfect sense. I mean, you'd expect you're going to have a slowdown in new infrastructure development when everyone's locked down. So I am interested, however, in the option of encouraging borrowing, because that's something that they've been quite keen to move on in the past. So, Josh, I know that you were also thinking that the Chinese government would be keen to boost debt to offset this slump. Did you find anything to indicate that they're having any success with that from your look at it?
The answer is actually no, really. Joe, can you pull up the first chart in today's news? That's the nothing impulsive chart just at the top.
Absolutely.
So this chart that Joe's going to pull up there is going to be showing us the flow of new credit issued from the private sector as a percentage of GDP in the Chinese economy. So credit impulse is arguably the largest driver behind economic growth in China. New bank lending in China tumbled more than expected in July as broad credit growth actually slowed. So there's a few reasons for this: fresh COVID flare-ups that they're having over there, worries about jobs, and a deepening property crisis as well. This has left companies and consumers a bit more wary about taking on more debt currently. So some analysts are pointing to this recent glut of liquidity in interbank money markets as a further sign of weakness as well. But overall, there's no signs that these things are anywhere near fixed yet in China, or that, you know, the current measures are going to be going very far in solving the underlying issues, which of course is not just a China issue at the moment. That slowing growth is of course becoming a bigger problem globally.
Absolutely, and that's something we've been talking about non-stop. Really, is the potential for that slowdown to really impact us broadly across the globe.
Globally,
another topic I really wanted to get your opinion on, Josh, was the potential for a sharply devaluing yuan. The Ainslie article mentions this idea that what China is doing to try and reduce this recession risk really adds further to US dollar strength. And this concept of the US dollar strength is referred to there as a global wrecking ball. And we've talked about that before. Yeah. And that global wrecking ball is being unleashed really on financial markets generally. So how do you see that situation? And what are some of the risks of further US dollar strength unfolding?
Well, wrecking ball is a phrase that we have been liking here. So great question. So absolutely anything that adds additional strength to that US dollar here is big concern. I'd like to just add that some more context around maybe why that strong USD is bad for the global economy, and why we keep referring to it as that wrecking ball. There's a good reason for it. I love the tweet at the end of today's news, Joe, if you can pull that one up for the viewers to have a look at as well. So what we could be looking at in this chart is that next leg further high in the US dollar strength, particularly against the yuan, which will be, you know, creating a huge problem considering the scale of the Chinese economy, almost as large as the US. So this could actually prove to be the next economic crisis that needs managing this year, just another one this year, guys. So we're in a period of economic uncertainty, as we say pretty much every video now, and all of this seems to be feeding US dollar strength. Big money is being moved by institutional investors like banks, retirement funds, as well as retail investors too, and they're all looking for somewhere stable, which appears everyone seems to be running to that US dollar, which is why it keeps going up. Additionally, this makes more problems because the sheer amount of dollar debt that exists outside the United States domestic economy due to the dollar's status as that reserve currency globally. So that comes hand in hand with all these slowdowns that we're seeing. So that dynamic has led us to all the complications that we're seeing at the moment. Firstly, a strong dollar, not great for consumers globally outside of the US. It's great for consumers inside. But it means American goods and services are more expensive outside of the US. So, you're talking your international companies that are getting really hurt at the moment. So your Apples and your Teslas who are selling products overseas and getting a lot of their revenue from consumers in other countries. The price of those products overseas is actually increasing. And these shifts in the exchange rates is also influencing how they do business over there. They may be building in a little buffer to the price to counteract for that so they don't have as much risk. And also that poor conversion rate back to the US dollar is hurting their business as well, particularly that US tech sector, which generates around 60% of its revenue.
Yeah, it's a massive sector, isn't it? I mean, it's a
huge,
substantial 60%. Part of it.
Yeah. So none of that's great, and especially for emerging market economies. So, your Indias and all that. That's the predicament right now, is the US is the greatest benefactor of it, of, the strength seen in the US dollar. And we're starting to see perhaps, other countries starting to stamp their feet and not cop it anymore, and see how they can resolve that US dollar wrecking ball problem.
Yeah, the strength and the unintended consequences of an ever strengthening US dollar, it's definitely something that we need to keep paying attention to, and I'm sure we'll be back on that topic again. It seems to not be going away. I suppose to bring everything together today, when we specifically think about China, this is only one side of the growing number of geopolitical issues we face when you look at all this, particularly from Australia's perspective, because China is obviously a major player in our region. So we'll need to keep paying close attention to things like Chinese interest rates, the value of the yuan and the US dollar in that, and the overall performance of the Chinese economy, I suppose, alongside the constant talk of conflict and even war that's been dominating headlines of late. So well, I'd say there's a lot to keep us busy here in the weeks and months ahead, I think.
Absolutely.
Couldn't agree more. We open up the discussion to questions. We didn't have any questions this week, but I actually have, not this week, for this particular episode. But if you do have questions, send them into insights@goldsilverstandard.com. But I've just the general, what do we think? What's our feeling because of this new lowering of interest rates from China? How do we feel this may have what short-term impact on the price of precious metals, even some of the cryptos? How do we feel that those may fare because of this recent news?
I think it's consistent with what I've been saying, that we really are at that crossroads where we have to make where the economy has to make a decision of, are we heading to a pivot? So are we turning away, which is effectively what we've just witnessed today, from China, where they've said, no, we're going the other way now because the economy's slowing down. If we saw the Fed do that, so if we see the US step into that role and start going, no, we have to pause and we're going to start injecting liquidity again. And remember, China is absolutely happy to do that here. They're absolutely happy to do that additional money printing, that additional liquidity injection. I think it's off to the races for risk assets, which would include things like crypto. And it's probably also off to the races for precious metals, because it means inflation was never really stamped out. And that's probably my longer term view, that ultimately the pivot will come before we fully get rid of inflation. It will be here embedded for a long time. So I don't see a downside scenario for precious metals or crypto or any risk asset really in any scenario where the Fed is changing course and doing exactly what the Chinese government has done here, changing direction from raising rates to lowering rates, because I think that injects more liquidity. That liquidity is going to go somewhere, and that will be ultimately the beneficiary, gold and crypto and other risk assets.
As they also put it, printer goes brrr.
Printer goes brrr is a much more efficient way of saying what I just said, yes.
Yep. So,
agree, Chris. When we look at things, denominated in money supply, so M2, those risk-on assets they'll fly. We've seen it in the last few years as well. Whenever they print, those ones go up, and then when we divide it back into M2, we can see what actually performed outside of just the injection.
Yep, fair enough. And that's why we say here at Ainslie, and we agree, and it's Gold Silver Standard Insights to balance your wealth in an unbalanced world. So that's why, the three of us, we have our certain assets, whether that be gold, silver, some crypto as well, and some other stuff as well. But we want to balance it for sure, because we don't know where the world is going. So you've got to have a few eggs in different baskets. Now, again, if you have questions for tomorrow's GSS Insights, first you've got to watch tomorrow's news, or look at tomorrow's news, and that's obviously going to be on the ainsleyBullion.com.au website. And what I'll do right here is I'll just share the screen, because that always helps, doesn't it? Right here. So, of course, over at the ainsleyBullion.com.au website, and it's the news section. When you get to the homepage, it's the news section, and you'll get the next one coming, whatever that's going to be tomorrow. Can't wait to find out what it is. And if you have questions based on that, then you can ask in two ways. You can send us an email to insights@goldsilverstandard.com, or even better, jump on the Discord channel. Now that's discord.gg/gold. And then if you haven't been on Discord before, you sign up in the regular ways you would normally sign up for other types of communities and socials like this. And you can pop your questions. You can DM one of the admins, or you can just pop your question as in the main chat as well. And what's going to happen, one of us or more of us, after you see this video, we're going to be in the Discord chat, and let's keep that conversation going. So we'll post this video that you're watching right now in the Discord chat, and we can continue the conversation. Any final words from either of you two gentlemen before we do the big wrap up?
No, just reinforcing what you just said about the Discord channel, remembering that the more people that engage in this conversation, it really does bring value to everyone. So, no question is a stupid question when it comes to this stuff. We're all learning as well.
Yeah.
So, ask those questions about the news, get them in there. We're more than happy to go, because often it'll take us down a different angle from what we sort of were thinking we were going to talk about. So absolutely keep those questions coming in, because, we'd love to answer them.
Absolutely. Well, so go ahead, Josh, sorry.
No, I was completely agree with Chris. It's a learning journey. We get a new bit of information every day, and we'll cover it, and love if everyone joins in.
Absolutely. So balance your wealth in an unbalanced world. That is it for GSS Insights for today. We'll see you tomorrow. Take care, and we'll speak to you soon.
Thanks.